Welcome to Commerce GYAN. So today we are going to touch upon a very important topic which is connected to journal entries, but it is related to the complex journal entries. These complex journal entries are the ones where many students make mistakes in writing them. So I'm going to explain them in detail today, how they are written, what is the conceptual understanding behind writing those journal entries, and at the same time I'm going to solve a number of illustrations connected to these journal entries. Also, a reminder to those who are coming to this video first that I have been uploading all the videos till now which are connected to basics of accounting learning, and just in case you want to go to those videos, you will have to go to the playlist of this video series. So which is playlist related to basics of accounting. This is part number 6 of that series. Also, you can keep yourself subscribed to this channel. Click on the notification icon. So as soon as I upload a video, you will get notified that there is a new part on this learning series, and you can go further in your accounting learning. Fine. So let's proceed to understanding complex journal entries. So what are we going to learn today? Today we are going to learn first of all compound journal entries, right? In the complicated journal entries, one type is the compound journal entries. Then we will be dealing with discount entries. And discount is of two types, trade discount, cash discount. We learn how to note these in the journal. Also calculations, how they are done of trade discount and cash discount. Then we will also understand the journal entries for recording of fixed assets. Now, fixed assets are a special type of entry because there will be certain cost accounting principles and all applied. So, you will have to understand this in detail. Next is you will also have entries connected with journal entries connected with losses. So, there could be loss by fire, loss by theft, bad debt losses, and so on. Then there are times when business gives free samples of goods for the purpose of marketing advertisements. So how to record that in your books of accounts. And finally, you will have a number of illustrations for practice of these journal entries. So watch this video till the end so that you get the knowledge of all these detailed types, 5 types, and also illustrations, right, at the end. So what are compound journal entries? First thing, now we have learned journal in the earlier videos which I have uploaded. In that we have seen that when you have to make a particular journal entry, you have one side which is debit and another side which is credit. Now usually you will have one account which is debit, another account which is credit. Let's suppose you have a journal entry saying paid for salary. So what do? Paid for salary means there are two parts of this account. One is your cash account and the second one is salary account, right? One account which is salary account will be debit and cash account will be credit. Now, this is how a normal journal entry is written. In compound journal entries, you will have a combination of different journal entries together if they have common accounts. So you will have more than one debit account, and you may also have more than one credit account. So it could be like more than one debit account and a single credit account, or there could be a single debit account and more than one credit account. Okay. There could also be more than one, and there will be more than one debit accounts and more than one credit accounts in a single entry. So this is how compound journal entries are basically, this is what is basically a compound journal entry. Now we will see examples of compound journal entries to understand this particular concept more clearly. Okay, the first example that we have here is Abhay started business with cash 50,000, computer 20,000, and also business has taken a loan in cash of rupees 30,000. So all these are the different parts of this transaction. Now let us see how to record it. Now first thing, we have to identify the accounts. So one by one, let us write down the accounts in this. Abhay has started business, so it will be Abhay's capital account. First account that we have is Abhay's capital account. What is the second account that we have here? Second account, if you see, you have cash, computer, right? These are the other two accounts. So we have cash account and we have computer account, which he is bringing into the business, correct? Then comes your second transaction. Second transaction in the same date, you can say, is business loan taken in cash of 30,000. So we have, this is the first part, and second part is the loan is taken and in cash. So cash account again, and we have loan taken. Loan taken account. Now we'll write the amounts also just to be sure. Cash is 50. Here, cash 50,000. Then you have computer of 20,000. Then again loan cash is taken 30,000. Loan account will also be 30,000. Now in this first part of the transaction, if you see capital which is brought in is of 50,000, 70,000, right? Basically combined together. This total will be of these two. So 70,000 will be Abhay's capital account. Now, if you have to write the different types of accounts, you'll say Abhay's account is personal account, cash account is real account, computer account is also real account, it's an asset. Then cash account here also is real account. Loan taken account is what? A name, right? Somebody gives you the loan. So it will be personal account, loan account, right? Now we have to write the journal entry. In ordinary circumstances, how would you write this journal entry? You would say, if you have to write the journal, amount that will be debited, it is cash and computer, because cash is brought in and computer is also brought in. So anything which comes in, debit what comes in, credit what goes out. Applying the rule of real account, I will write here cash account is coming in. Cash account debit. Amount how much? 50,000. And I will have two Abhay's capital accounts. 50,000. Fine. So this is how I would have written the first entry. Second, and I would write the narration also over here. Being cash brought in into business. Then computer account. Computer is brought into business. Computer account debit. Amount how much? 20,000. This is the debit side. To Abhay's capital account. Amount is 20,000. Now what is happening here is I'm writing two times Abhay's capital account again, right? Instead of that, what I'm now going to do is I'm going to combine this entry into a compound journal entry. Correct? So what I can do here, I can, instead of writing two journal entries here, I will write one single entry here. I will write cash account debit 50,000. Computer account debit 20,000 and to Abhay's capital account. How much is the amount? Total is 70,000. So credit, I will directly write 70,000. So this is how a compound journal entry is written. This is your compound journal entry. Hope that is clear. So here I have one debit, second debit, and two times I have the same account which is credited. I'm going to combine it into a single entry. Now there was one more thing that was happening on the same date, that is loan was taken, cash account and loan taken, or loan account, correct? So cash is brought into business. Real account rule says debit what comes in, credit what goes out. So cash account debit, cash account debit, amount is 30,000 loan taken, and to loan taken account, because the giver's account is credit. So loan taken account is also credit. 30,000. Now, instead of writing these two transactions, now if you see this, for this entry cash account 50, computer 20, Abhay's capital 70. Again here I'm writing cash account and I'm writing loan account. Instead of this, what I can do, I can even combine this because it's on the same date. If you want, you can write these two entries, no harm. But if I have to again write this compound journal entry, how would I write it for the same date? I could again combine these two transactions saying cash brought in. So cash account debit, 50 plus 30, 80,000. Then computer account debit, 20,000, same amount. To Abhay's capital account, Abhay's capital account will remain 70. Okay, it won't become 1 lakh. It will remain 70,000. And to loan taken account, 30,000. Have you got it? So what I'm doing, I'm combining these two. 1, 2, 3 debits. Cash and cash is combined here. 50 plus 30, 80. Computer account, which was here, I'm writing here differently. Computer account 20,000. Then Abhay's capital account 70 I've written because it's only 70, right? Abhay has not brought in 1 lakh. He's brought in 70,000. And what is that other 30,000? How does that come in the business? It has come in the form of a loan. So that's why I write here cash account 80. And in this cash account 80, 30,000 is of loan taken. So loan taken account 30,000, right? So the narration for this transaction would be being cash and computer brought in as capital and loan taken as capital and loan taken in cash, or loan taken, you can just write in cash. Right? Hope that is understood. So this is how a compound journal entry will be written. Fine. Now we are going to see the other transactions, some other transactions examples. Yes, the next transaction that we have is paid for repairs and maintenance 5,000, salary 20,000 and 2,000 for newspaper advertisement. So we have different accounts here. Identify the accounts. Repairs and maintenance is one account, salary is another account, and advertisement is the third account. And what is the fourth account? How are you making these payments? The fourth account would be cash, right? Because you are paying in cash. Now, if you had to write in the normal circumstances, how would you write? You would write basically in the format of debit repairs and maintenance, because repairs and maintenance account is, you will debit 5,000. And how are you making the payment? You are making the payment in cash to cash account, 5,000. This is how you would write the transaction. Second transaction, you would write it as salary paid. So salary account, debit, amount is 20,000 to cash account, because cash is going out of the business. Debit what comes in, credit what goes out. Cash is going out. So 20,000 is credit. Then third part of this transaction is 2,000 was paid for advertisement. Then I would write advertisement account, debit, 2,000 to cash. This is how in normal circumstances your journal would look like. Instead of that, if I'm making all three payments on the same date, I can combine this into what I call as a compound journal entry. How would you write the compound journal entry of these? Compound journal entry of the above three would be written by taking all the debits together, repairs and maintenance account debit, amount of 5,000. Then salary account also is debit. So I write the debit first. Salary account debit, 20,000. Then advertisement account debit, amount is 2,000. And 2. What is the 2? 2 is cash account, because you are making all three payments by cash account. Now what you will do is you will add up these two. 20 plus 5 and 2 is 27,000. right? So this you will write being amount paid for repairs, maintenance, salary, advertisement, and you will close the bracket. So you write the narration. Fine. So this is how a compound journal entry is written. You will have more than one debits in this entry. In the earlier transaction, if you remember, we had two or more debits, two or more credits. Fine. So here we have three debits and we have just one credit, and that is also fine for if we have to write a compound journal entry. Correct? Now let's see the third example. Third example here is bought goods rupees 20,000 worth and furniture 10,000 from Akash and company. So you're buying, one is goods, second is furniture, and from whom? From Akash and company. So three accounts involved: goods account, furniture account, and Akash and company account. Goods account is real account, furniture account real account, Akash is personal account. So what are you doing? Goods brought in debit, furniture brought in debit, and who is the giver of both of these? Giver is Akash and company. So I'm going to now write directly the compound journal entry. How? Goods are brought in purchases account. Purchases account debit. Amount is 20,000. Next is furniture account. I'm bringing in furniture account debit. Amount of furniture is 10,000. And who is giving this? Akash and company is giving. So to Akash and company, personal account, giver's account is credit. Amount, how much he's giving now combined, right? 30,000. So 20 plus 10, 30. And I will write the narration being goods and furniture brought. Furniture bought. Got it? Right? So this is how, again, you can say this is an example of compound journal entry. Hope that is clear. So compound journal entries, again, we are just revising in two lines. Compound journal entry would be the journal entry where you have more than two or more debits, or two or more credits, or it could be two or more debits and two or more credits. Correct? So hope with these three examples, now you will be able to write very correctly and clearly compound journal entries. Of course, it is not necessary that you need to write a compound journal entry always, but this is how you can ease your transaction if it is happening on the same date, if two or more things are happening on the same date. Now, don't say that I'm going to combine all entries of cash in the journal and write a compound journal entry. That is not acceptable. If it is happening on different dates, you will have to write the journal entry separately. Okay. So not necessary that every time you have two or more times cash in different transactions, you club it. Not necessary, right? And it's not required and not right also. So only if the transaction is happening on the same date, many things combined together, like this one where you're writing purchases and furniture, two things, where Akash and company is giving these two things to the business, then we will club it and write it as a compound journal entry. Hope that is clear. Next, we are going to understand concepts of trade discount and cash discount. Let's see what is a trade discount first of all. Have you ever come across somebody saying that if you buy in bulk, I will give you a discount? Okay. So that is where the question comes of trade discount. So what is trade? Trade means buying and selling, correct? So trade discount is given, remember, on buying and selling of goods which are done in bulk. So bulk purchase, bulk sale, when it happens, then there is a fixated discount which traders, or you can say manufacturers, would be giving you. And this discount may be a percentage like 5%, 10%. If you buy 1,000 units of a particular product, then I will give you 5%. If you buy 2,000, I will give you 7%. If you buy 10,000 units of that good, I will give you 10%, and so on. So they could have a fixated, decided discount which they will be giving on a particular bulk sale. So remember, trade discount is always given when they want to sell more goods. Correct? Secondly, trade discount is not necessarily given when you make a payment. So even if you don't make the payment immediately, you want to pay that person after 2 months, they have taken credit, still you will be given trade discount, because trade discount is nothing to do with the payment part of it. Trade discount is just to do with the bulk, you can say, sale which is happening in that transaction. This is generally given by, you can say, the larger portions, or larger, you can say, this is generally given by the larger sellers, like the manufacturer, wholesalers, and so on, distributors maybe. So they're not generally given by retailers. Retailers don't have the concept of trade discount in many cases. Trade discount they will avail, they will get. But retailers generally don't give trade discount. Okay, unless and until it's a very rare case. Then what is the importance of a trade discount? Trade discount will help reduce the margin, or sorry, help reduce the price and increase the margin. Correct. So your price, if it is 10 rupees and you get a 10% discount, a trade discount, then the price falls to 9 rupees when you're buying. And when you are selling, you can also sell the commodity at the same price which was agreed upon. Like if you buy the product at 10 rupees, sell it for 12 rupees. Your margin is how much? 2 rupees. But if you buy the product for 9 rupees and you sell the product at 12 rupees, what happens to your margin? Your margin will increase by 1 rupee. Now it becomes 3 rupees. So this is how trade discount benefits the people in the supply chain, like the wholesalers, the for the people who are buying in bulk, like even the retailer. When the retailer sells to the final consumer, he will avail the benefit of trade discount by increasing, improving his margin in that sale. And remember, this particular trade discount is not recorded separately in the journal. Though we calculate the trade discount and the price in accordance, you will not record it as a trade discount account. Remember this. So you will never have trade discount account written in journal. Keep this in your mind. Now, what is cash discount? Cash discount is connected with the quick payment of the towards that product. So whenever a retailer, whenever a person, like in the entire supply chain, it could be a wholesaler, it could be manufacturer, anybody in the supply chain, if they want to get the quick recovery of the amount, that is the money that is pending with that person when the sale had happened. So any debtor is there and you want a quick realization of that money, then you will give him cash discount. So when are you encouraged to make a payment to somebody? Whenever you're given a discount. Suppose I say that you owe me 1 lakh rupees. You have to give me 1 lakh rupees. And against this, I give you a discount of 10,000 rupees if you make the payment 15 days earlier. Will you be encouraged to make the payment earlier? Definitely yes. You will say, why not? I'm saving 10,000 rupees in this entire amount. So instead of 1 lakh, if I have to give only 90,000, I will definitely try and make a payment in the earlier instance. So this is the first important thing related to cash discount, that cash discount is not given for the purpose of selling more. It's generally given, it's more of given in case you want to make a quick realization of money. Motive is basically to reduce your debtors. Debtors are who? The people whom you will be getting money from. That is, these are the business receivables. So receivables against your credit sales. So if you want to realize these quickly, definitely you will give them cash discount. You will say pay fast. If you make the payment fast, I will give you a discount, right? Then it is given only when the payment is made. Okay, don't I mean, if you have to distinguish between trade discount and cash discount, you will clearly understand that trade discount is not connected with any of the payment part. So even if the goods are sold and you are giving that person credit, you will give them trade discount. Even if the person takes the goods and makes the immediate payment of cash, still they will get trade discount. So even if they pay, even if they don't pay, they get trade discount. But cash discount is subject to payment. So if the person does not make the payment and he does not make the payment in the stipulated time period, you will not give them cash discount. So the seller is not going to give the cash discount. So this is a very important point when you're talking of cash discount. Fine. And anyone in the supply chain generally gives cash discount. And remember, a cash discount account will be separately recorded. So whenever I write discount account, discount given, discount received, it means it is connected to cash discount. Got it? So when you make a payment and you get a discount and it is separately recorded, what kind of discount is it? It is cash discount. Fine. We'll see some examples on trade discount and cash discount and we'll move further. Now we are taking the examples on trade discount and cash discount. The first example here says purchased goods from Mandira 10,000 and she has offered us 10% trade discount. What is the first basic concept of trade discount and cash discount? Trade discount is not recorded separately. Remember this, not recorded separately. This is very important. And what about cash discount? Cash discount is recorded separately. Correct? So this is what you have to remember when you are talking about trade discount and cash discount journal entries. The rest of the, definition and understanding of cash and trade discount, hopefully that is clear in the theory part we learned earlier. So now let's proceed to examples on these two, trade discount and cash discount. The first example that we have here is purchased goods from Mandira 10,000 and she offered 10% trade discount. Now two accounts here are Mandira's account and purchases account. Purchases account and Mandira's account. There is nothing like cash or check or anything because there is nothing mentioned as paid Mandira. Okay. Or since Mandira's name is written, we assume that it is going to be on credit, right? She has offered 10% trade discount. 10,000 is the value of the transactions. Now, I'm not going to write 10,000 of purchases here, but I'm going to reduce the trade discount. So how will I write it? I will take the amount of 10,000 first, right? Less trade discount. How much is the trade discount? It is 10%. So 10% trade discount means 1,000 is the amount of trade discount. So what is the value of my purchases now? Purchases will be valued at 9,000, right? So I am going to write the entry, the transaction that I'm going to write will be written as purchases account. So let's put it in the journal only directly. So the first transaction will be written as purchases account debit and to Mandira's account. How much is the amount now? I'm not going to write 10,000. I'm not going to write 1,000, but I'm going to write 9,000 directly. So these are not the amounts I write. I write 9,000 directly on debit. I will write 9,000 on credit. Also, I will write 9,000. And in brackets, I can write in the narration being purchased from Mandira at 10% trade discount. So here you can mention that you got a trade discount of 10%. So when you're writing in the journal, then you will mention the amount of trade discount, not otherwise. Okay. So this is the first transaction that I could write in the journal about trade and cash discount. Now let's proceed to the next example. What is the example saying now? Goods sold to Gautam Enterprises 50,000 and offered 10% cash discount. Now this is a little tricky because both the name is mentioned and you're also having cash discount. So should I assume that I made a payment to, should I assume that Gautam made a payment to the business? Or should I write Gautam Enterprises first? What should I do? The answer here will be that Gautam Enterprises will not be in question because the mention of cash discount is there. As I told you earlier, that cash discount always will indicate that the amount is received or paid. In this case, since it is sales, the amount is received. So we assume we take into consideration cash amount received. So what are the two accounts in this case? The two accounts are sales account because you are selling the goods. So I will write the sales account. Second one I'm just doing a rough work here. First, sales account, and second is cash account directly, not Gautam's account. Okay. And also, since you are receiving cash discount, you will write discount. Sorry, you are giving cash discount, you will write discount given. This will be a third account. Why am I taking discount account separately and not directly subtracting like this example? In this example, I directly subtracted and I wrote 9,000. In this example, why am I taking discount account separately? The reason is because this is cash discount. If you see here, cash discount is recorded separately. So I will have to record discount given separately. Now, sales account, how much will be the sales in this case? Sales are 50,000, correct? Sales are 50,000. Now, am I receiving this 50,000 in cash? No, I am receiving less. How much less I'm receiving? If you see, 10% cash discount. So I'm not going to receive 5,000, but I'm going to receive 10% less. How much is the discount offered, discount given? It is 5,000, correct? And so obviously when I receive cash, it will not be 50, but it will be just 45,000 after I reduce the discount. Have you understood? So 50,000 minus 5,000 will give you 45,000. Now, how to write this journal entry? Sales is goods. Goods, basically, we are talking of a real account. Goods are going out, so debit or credit, it will be credit, right? So goods are going out, so credit. Cash, real account, cash is coming in, so debit. Discount is a nominal account. It is an expense in this case because you're giving discount, so debit. So how do I journalize this? Now debits I'm going to write first. So I will write the second transaction here, cash account debit, 45,000. Discount is expense, so discount given account. Also debit, 5,000. And to sales account. To sales account, 50,000. Correct? And here I can write it as being sold goods at the rate of, how much is the discount? 10% cash discount. Being sold goods you could also have the name written to Gautam Enterprises. If you put it correctly, Gautam Enterprises, I will write in the narration at 10% cash discount. Correct? So this is how you will write the journal entry of this transaction, which is consisting of cash discount. This is the first entry just dealt with trade discount. The second entry dealt with cash discount, and the second entry in fact dealt with only cash discount. Okay. Now we are going to go to the third transaction. The third transaction, third example says sold goods to Mubina worth 1 lakh and gave her 10% trade discount and 5% cash discount. Now you would say that how to record it. There will be a little bit of confusion because there are both discounts given here, right? We are selling goods. First, let us take a rough work of this. We are selling goods, right? So sold goods means it will be sales. First account that you have will be sales account. Then second account that we have, we are selling goods to whom? To Mubina, right? But at the same time, you also see that what is happening is there is cash discount given. So obviously this entire amount, whatever was due from Mubina, is going to be received. So there won't be any Mubina account here because there is cash discount. Cash discount denotes that you have received the payment. So I will write here second account will be cash account. And I don't need trade discount account, right? But I definitely need cash discount account. So discount given account. Again, it is sales discount. So I'm writing discount given account. Now the question will be of how to write the amounts, right? The amount is very crucial in this particular example. Now, first of all, let us understand what was the sale. Sales took place of 1 lakh rupees to Mubina, right? 1 lakh rupees. Then what happened? You gave them trade discount and also you gave them cash discount. Trade discount given was 10% and cash discount given was 5%. Now, always remember, first you will reduce trade discount. Got it? Always remember, first you have to reduce trade discount. Second, after whatever the balance is remaining, you will reduce cash discount. Got it? So sales 1 lakh, correct? In this, I'm going to reduce the trade discount at the rate of 10%. This will be 10,000. So 90,000 remains. This will be the amount before, this will be the amount you can say recoverable from Mubina. So Mubina's account, you have to recover 90,000. However, I'm getting this money immediately. So I'm giving them what? Cash discount. So how much is the cash discount? Cash discount given is 5%. So 5% of 90,000. Okay, of 90,000. So that comes to 4,500. I hope you're getting how I'm doing the calculations. Basically, I will have the amount that will be received in cash. Cash account received would be 85,500 in hand. So now how to write the amounts? See, basically sales will be of the entire. Will I write 1 lakh here? This is the question. The sales will not be, should I write 1 lakh? Should I write 10,000? Should I write 90,000 in the journal? The answer to this is we will not write 1 lakh, but we will write 90,000. Correct? Cash received will be 85,500 only because I have given a discount, and discount given account will be written as 4,500. Now I'm going to write this in the journal. Hope it is clear. So I'm repeating once again. First, I reduce the trade discount. This is what Mubina has to pay the business, but Mubina paid immediately. So you gave a trade discount, a cash discount of 5%, which is 4,500. After reducing this, you got 85,500, and this is what is the amount recovered. So let's put this in the journal now. What is debit? What is credit? Cash is coming in debit. Discount is given expense, so debit, and sales account, goods are going out, so credit. So let's write the debits first in the journal. Cash account, debit, discount given account, debit, and to sales account. So cash received is 85,500. Amount of discount given is 4,500, cash discount given, and sales happening is 90,000. So always remember that the trade discount amount is netted off. There is a net off of the trade discount, and then you write the amount in the journal. So being sold goods to Mubina at the rate of 10% trade discount and 5% cash discount. This you will have to write in the narration. Be careful, don't miss out on this. You will have to write the details in the narration, whatever is the trade and the cash discount given. All right. So hope that is clear how you write these combined ones where you have also given trade discount and you have given the cash discount. Fine. Fourth transaction says Gautam Enterprises in entry number 2. This second entry which we did, has returned goods of 10,000. Now here nothing is mentioned whether it is before cash discount, after cash discount, we don't know anything. Doing here is basically I'm going to tell you that this amount is gross amount, okay, so that we know how to write the entry. Both of these I'm going to put a gross amount. Gautam Enterprises is entry number 2, return goods of 10,000. Now what is happening in this entry? Gautam Enterprises had bought goods of 50,000 but we gave them a discount. Correct? Now, out of these goods, they are returning us 10,000 worth of goods, which is gross. Gross means before this cash discount. So, of this 50,000, they gave back the amount of 10,000. Now, are we supposed to pay them 10,000 back for the goods that have been returned? No. We have already given discount of 10%. So, we have to pay them after whatever the discount is reduced. We can't pay them the entire 10,000. Otherwise, it will be a loss for us. So, if they are returning goods worth 10,000, we will first reduce this 10% cash discount and then give them back. Now, how to write it? First, let us understand how this transaction will have the accounts and everything, and then we will proceed to writing of it in the journal. Okay. First, understand that Gautam Enterprises has returned goods. Now, even though we are saying that Gautam Enterprises has returned goods, we are not going to write Gautam Enterprises in our books of accounts. We are going to write cash account because they were the ones who made the payment immediately. So we are also going to give them back the cash. Now, how much cash should we give? If they are returning goods, the returned goods are worth 10,000 gross. What do you mean by gross? Gross means before discount. If I return 10,000 back, that means 1,000 will be my loss because I gave them a discount earlier. So I have to reduce this 10% discount before I give them back. Which discount is this? This is cash discount. So 1,000 I reduce, 9,000 is what I am going to give them in cash. So cash account will be given is 9,000. Now I am having discount, okay? Discount account is to be reversed. Discount given account is to be reversed of 1,000. And also there is sales return happening. So sales return account, right? So these will be the three accounts. Cash account, are we receiving cash or giving cash? Giving. Cash is going out from the business, so it will be credit. Discount given account, I'm giving discount earlier, which is now to be reversed. When I gave discount earlier, it was debited, so now I have to credit because I'm getting back this amount. Sales return, goods are going out from the business. Debit what comes in, credit. Sales return means basically goods are coming into the business because earlier I sold goods, goods went out, so it was credit. Now we are getting these goods back, so sales return entry will be debit. So now how do I write it in the books of accounts in the journal? I will put your fourth transaction, sales return account debit. How much is the sales return taking place of? Sales return is taking place of 10,000. Why 10,000? Because total amount that the products that were sold earlier returned are now 10,000 of gross amount. Cash that I'm giving him back is 9,000 and I am reversing the entry. Remember, this is reversal of the discount given account. Discount given account, I am reversing the journal entry. Now, one more concept you learned here is of reversal. So, if you gave them discount here if you see, it was discount given 5,000, right? Of this discount that was given earlier, what are you doing now? You are taking back this 1000 discount because it is 10,000 of goods return. So out of 10,000 of goods return, how much was the discount value? It was 1000. And how much was the cash value? It was 9,000. Hope that is clear. So here I'm going to write in brackets, being goods returned by Gautam Enterprises gross, okay? Gross amount was 10,000, right? 10,000 gross amount has been returned. Now, so the fourth transaction is over. Fine. Let's proceed now to understanding the fifth one. Fifth one, goods returned to Mandira from entry number 1 worth 1000. What was entry number 1? It was related to purchase. So what is this entry related to now? Purchase return. So we are giving back the goods that we bought earlier from Mandira. So purchases return is the first account. Secondly, the goods that were returned were worth 1000 and she had given us trade discount. So we are not returning goods worth 1000, but we are returning goods worth 10% less. So though this is gross amount given, we can't write the gross amount directly. Okay, remember this. So fifth transaction that we have, Mandira, right? Because we are buying in credit and there was only trade discount. So Mandira's account. And secondly, we are returning goods back which were purchased. So purchases return account. These are the two accounts. Now you will say, where is discount given or discount account? Watch this transaction which we wrote in the first case. What did we write here? We written purchases and Mandira. There were only two accounts here because it was trade discount. Was there anything about cash? Nothing about cash. So there is no question about cash discount or discount given or discount reversal. Here we will directly net off the amount and write the return entry. So what is the return amount? How much is how much are we returning to Mandira? We are returning goods worth 1000. However, we can't write 1000. We will have to reduce the amount of discount. So goods, I'm just putting here for your reference, goods worth how much? 1000 were returned, less trade discount, which we had claimed earlier, 10%, 1000 on 1100. So finally 900 rupees is what we will have to get from Mandira, right? Goods worth 900 is something which we are returning. So how do I write purchase return entry? Purchases was debit. So purchase return means goods are going out from the business. So it will be credit. So I am going to write Mandira is the receiver of that goods. Writing Mandira's account debit 900 because this is the amount that she has to give us back to purchases return. $900, right? Being goods bought earlier returned. Goods bought earlier returned. Correct? So this is how you would write the journal entries for the trade discount and the cash discount. We're going to take a couple of more entries at the end of this video also in the format of illustration. So watch this video till the end if you want more transactions on trade and cash discount. So hope this part is clear how you journalize the trade and cash discount entries. Now we come to journal entries for fixed assets. Now what are fixed assets? First thing, fixed assets are the assets, the properties of any organization that are connected to the long-term, you can say, investment. So if this investment is made in the business and this investment in the assets is giving you the profits. So if I invest in machinery, this machinery gives me the profits. And the machinery is going to be with my organization for a period of more than 1 year. Then it becomes a fixed asset, right? Fixed assets are long-term assets, and these long-term assets are bought by the organization with the motive of increase in the business, right? Or it is with the motive of support system for the business. So if I buy a car or I buy a transport vehicle for the purpose of transporting goods from one place to the other, then it is also a supportive activity for my business. Even though it's not manufacturing, making goods, it is supporting my business objective, and hence, and also at the same time for the long run, so it becomes a fixed asset. Fixed assets could be tangible or intangible. We have learned that tangible assets are the ones like, you can say, furniture, fixtures, land, building, which we can touch and see. Or intangible assets would be the assets which are like patents, copyrights, trademarks, goodwill. All these are the intangible assets. Fine, got it. So first thing, we are talking about such type of assets when you're buying. So if a journal entry says purchase furniture, what does it mean? You are buying fixed assets. If the journal entry is asking you to record the record the purchase of machinery, then you're talking of fixed assets. So remember this. Now coming to the cost concept of accounting. If you recollect, we had discussed in principles of accounting video that there is a concept called as cost concept. Cost concept says that all the fixed assets are recorded at cost, or all assets generally, if we are talking of, are recorded at cost. So if I buy let's say a building for 10 lakh rupees, 10 lakh rupees will be the amount I record in my books of accounts. Fine. Next is important thing is that if the building value changes, suppose it increases, then the increase, the market price of that building is not recorded. Only land, if we talk, land is the only asset. So this is where we are talking about recording of the fixed assets. So fixed assets would be recorded at cost, what you pay for it. Fine. Now, when you make the payment for a fixed asset, it need not necessarily be only specific amount, like you can say the cost of the goods. Not necessary. It could be the amount of furniture which you're buying. You pay for furniture. That furniture has to be bought into the business up to the office, let's say, and when it's being brought to the office, you will have to make payment for transportation. Now, till the asset is put to use, that means till that furniture arrives in the office and you start using the furniture, whatever expenditure has been incurred, loading, unloading, installation, it could be transportation, all this expenditure gets added to the amount of the fixed asset. So this is where it's very important when you're journalizing such transactions, you have to remember that all the amounts, the fourth point in this particular slide, if you see, the cost of fixed asset will include all amounts right from the purchase of the asset to the time the asset is put to use. This line, remember, very, very important. Hence, all the expenses like transport, testing, installation, all whatever is required till the time of the asset becoming the, you can say it's being used in that particular business, it will be added to the value of the asset. Fine. So remember this part, very essential. When we go to the examples, you will understand it more clearly. So let's proceed to the examples now. I want to take the next examples now, which are connected with fixed asset purchases. Now, what is the main ingredient or main area which you need to take into consideration when you're talking of fixed assets is that whenever you are buying any fixed assets, you should understand that the fixed assets are recorded at cost. So remember this, fixed assets are recorded at cost. Now, when I say cost, cost means basically anything connected with the asset up to its purchase. Up to purchase plus any cost till it's put to use. So that means if the asset is purchased at rupees 1000, and you paid for 200 rupees of installation, the asset value will not be 1000, but it will be 1200. In ordinary course, this 200 would have gone as installation charges, but in this case, it is not going to be separately recorded as installation, but it will be recorded as the part of the asset. So this is a very important thing that you need to remember, that till the time the asset is put to use, everything incurred on it, every cost that you are going to incur on that asset will form a part of that asset cost, right? This is the cost concept of assets. Now let's move to the illustration that we are going to take into consideration. In this case, the first example says you are buying furniture worth 1 lakh rupees in cash, and also you are paying for transport from the shop to the office, rupees 5,000. So in this case, when I say the account heads in this case will be furniture and cash. Transport will not be a separate account head, but this transport of 5,000 will get added in the furniture account itself. So in this case, I will have the value of furniture, not just the amount of 1 lakh rupees which you are paying for furniture, but also the 5,000 rupees which you are paying for its transport. Now you would say this is not furniture, right? This is transportation. But transportation for what purpose? For the purpose of furniture purchase or furniture installation in the office. So whenever there is an asset purchase, cost of that asset will be these two things: asset up to the purchase, which is 1 lakh, and cost till it's put to use, which is 5,000 of transport charges. So total asset value in this case, furniture value will be 1 lakh 5,000. So in the journal, when you write, this first transaction will be written as furniture account debit. Now remember, furniture is real account. Real account rule says debit what comes in, credit what goes out. So total amount of furniture 1 lakh 5,000. This is the value of furniture being brought into the business. And 2, cash account. Why are we taking cash account? Because it is clearly mentioned that you paid for the furniture purchase in cash. Now in the narration, you will need to write being furniture purchased and transport charges paid 5,000. Transport charges paid 5,000. Now, why am I putting this in the narration? The reason, because whenever a person would see this 5,000, he will understand that furniture cost was 1 lakh and 5,000 was the transport, though we don't need to mention it separately. Got it? This is how the furniture transaction or the asset transaction will be recorded in the books of accounts. Now, next part is, the second is machinery purchased from Manu and company worth 1,50,000 and incurred an additional charge of 10,000 for installation of machinery. Now, is this particular transaction mentioning anything about payment? No, there is nothing about payment. So here we have two accounts, machinery and Manu and company, since there is no amount paid as such. So since there is nothing paid, this total amount of 1,50,000 plus 10,000, which becomes 1,60,000, will be machinery value. So in the journal, this second transaction will be recorded as machinery account. Machinery brought in, so real account, debit what comes in, credit what goes out. Machinery is coming in. Amount is 1,50,000 plus 10,000 of installation. So directly I write here 1,60,000 to Manu and company, because there is nothing mentioned about payment. So 1,60,000 Manu and company, I'm going to write here directly. And in brackets, you can write being machinery purchased and paid. How much you have paid? 10,000 rupees, 10,000 for installation. So this is how an asset value will be recorded at cost, and cost will include everything up to the machine or that particular asset, whatever it is being put to use. The third transaction, which is given in the examples, let's see what that is. Land is purchased and we paid by check rupees 10 lakhs, and registration and stamp duty was also paid by check 1 lakh. Correct? So total land value till it is probably brought into the business will be inclusive of your registration and stamp duty. Without registration and stamp duty, you cannot use that land. It cannot be in your name. So 10 lakh rupees plus 1 lakh, both is important. Market value of the land is now rupees 12 lakhs. Does this even matter? No. Assets are recorded at cost price. Very clearly, cost concept of accounting says assets are recorded at cost. So this particular amount of 12 lakhs does not have any value in this transaction. What is the value that we need to consider? We need to consider this 10 lakhs and we need to consider this 1 lakh rupees of stamp duty and registration. So together I'm going to write land, and you are paying by check, so we can write it by bank. Payment is made by bank. Bank is the giver. Giver account is credit. So land being asset is brought into business. Land account debit. Amount is 11 lakhs. 10 lakhs of land and 1 lakh of stamp duty and registration to bank account, because bank is making the payment on our behalf. So bank is the giver. Giver's account is credit. Being check paid for land purchase, or you can just write check paid and 1 lakh rupees was stamp duty and registration. Correct. So asset value is recorded at 11 lakhs and not 12 lakhs. So this 12 lakhs has no meaning because it is market value of the land. We are interested in the cost price, the amount which we have paid. So hope that's clear. So 10 lakhs plus 1 lakh we have written and the transaction is closed. Now next, fourth one is saying returned a defective chair out of furniture purchased in entry number 1. So we have here entry number 1. In this we purchased some furniture, and out of this furniture there was a chair which was defective of 5,000. Amount is received in cash for the return. So furniture is returned and we are receiving back cash. Now what is happening here? What is going out from the business? Can we say this is purchase return? No, because we have not recorded purchases. Furniture is an asset recorded separately as the head of furniture. So what is going out from the business is furniture, not goods. Okay, so here we can say that the amount that is to be taken into consideration is towards furniture, and second part of the transaction is cash. So there are two accounts, furniture account and cash account. How much amount we are returning is 5,000, right? So we are giving away furniture and we are getting back cash. Both are real account. What is coming in? Cash is coming in and furniture is going out. So we record the fourth transaction as cash account debit. 5,000 amount is returned, and 2 furniture account. Furniture account 5,000. So you can see here that we are not recording this transaction as purchase return because this is not per goods which are being returned. This is furniture which is being returned, right? So if any asset is returned back, it is taken out of the business or it is sold, it will be written to the value, or the amount will be written as credit to the asset and not as sales, not as goods return, and so on, right? So being furniture, defective chair returned, and cash received. So narration can be as per whatever you feel like writing in whatever descriptive manner. It need not be a specific narration, very much like very specific, but it can be just denoting what transaction it was, and one should be able to understand from that narration what you wanted to say. So hope these transactions are clear and you've understood how we do the fixed asset recordings that need to be done. The fourth type that we're going to learn now, it's connected to loss. Now, suppose you have an organization where there was theft that happened. Some cashier took away some cash from the cash box and you realized it later. What happens in such a case? Is that cash going to be recovered? If recovered, then it won't be your loss. But what if the cashier is not traceable? He's run away. So he took cash of 1 lakh rupees and he ran away out of town and he's not traceable now. Then what happens to that 1 lakh? Can you keep writing that I still have 1 lakh rupees cash in hand? No. Your 1 lakh is lost. So that has to be recorded to show that it is no longer recoverable. You don't have that much of cash. Imagine when you make a payment, what do? You record that and you say cash has moved out of the business, correct? Same way here, if you have lost something, it's not recoverable, then it has to be written off in your accounts. And this is where the transactions connected to losses and journalizing them will be taken into consideration. So we have to understand that the loss to the business is should be a permanent loss. That means it should not be recoverable. If it's recoverable, again we'll have to reverse the transaction. But a loss has happened and the loss currently is not recoverable, and that's why we have to show it as written off in the books of accounts. There could be various innumerable types of losses. Now we are going to deal with a few of them, like loss by fire, loss by theft, loss by floods, loss by embezzlement, and so on. So there could be any type of losses that happen. Then there is a special type of loss which basically we talk about is connected to debtors. You have given somebody credit, goods are given on credit, and this credit which was given now is not recoverable. So that becomes a loss called as loss by bad debts. Fine. So innumerable losses are there, and we are going to see now with examples how these losses are recorded in the journal. Fine. Let's proceed to examples. Now we are going to take examples on this particular loss, what we were just talking about. So any loss which is to be considered, and against that, what is lost? So is it goods that were lost? Is it cash that was lost? What exactly is lost? And accordingly, we will note down that particular transaction. So let's see how to do it. First transaction here is cash stolen by cashier 500. Now what has happened here? What kind of loss has happened here? Can we write cashier account? No, cashier account has no meaning, because though cashier has stolen it, now cashier is not going to make the payment to us, right? This amount which some may say that, okay, this cashier account should be written. No, cashier account has no meaning. We have lost something, and that is cash. And this 500 rupees becomes our loss. So there are two heads of account in this case. It is cash account and loss by theft. Okay, these are the two accounts. So we are recording the loss of 500 rupees. What is lost? 500 cash. And second part of this is something which we will have to show in our books of accounts as a loss, right? It's not recoverable. So cashier has stolen the cash, and by any chance, if the cashier will repay back the money, then just in case, okay, if this money was recovered, let's suppose. Okay, I'm just assuming from cashier. Okay, if this is how the transaction would be. If this 500 rupees is recovered back from cashier, then we will have again loss by theft, but we will reverse this transaction. Loss by theft only and cash only. These are the two accounts, because cash will come here back. Na? So cash is going to be taken into consideration, and loss by theft is taken into consideration. In first case, when there was a loss, so cash is lost, that time we know that cash is going out, so we credit, and loss is always debited because it's a nominal account. So this will be debited and cash will be credited. Reverse will happen when you recover it from the cashier. What will happen? Loss by theft is to be reversed. Now it will be credited. Okay, because you are recovering it, and cash account will be debit because this amount is brought into business. Why am I crediting? Not because this is an account of profit or it's an account of income, but I'm crediting it because I am reversing this transaction. Reversal. So even in case of reversal, you will have to write this opposite transaction. So some may say that, okay, why am I actually showing this as the amount of credit? It's not something which is profit, right? It is something in the format of a loss recovered back. So loss recovery is to be reversed. When I write an account debit, always remember when you want to reverse that transaction, you will show it on the opposite, which is a credit. Okay. Right now, this transaction has no meaning for us. We just have to focus on this particular part, cash and loss by theft, and write it in the journal. So first thing, whenever I write all the debit entries. So I will write here loss by theft, right? Account, debit, 500. And what is lost? What is going out of the business? Cash. So to cash account, 500, right? Being cash stolen by cashier. Correct? This is the first transaction. Now, second transaction, if we have to see, goods were damaged by fire, 10,000, and insurance claim accepted was 50% of the damage. So basically what is happening here now, something very specific is happening here. Not just that you have lost the goods, right, by fire, but there is also some kind of insurance which you're getting back. So this is a very important thing which you need to remember, that sometimes entire amount may not be lost. There will be part amount which can be also recovered back from insurance company. Now, have they said that the claim was paid by the insurance company? No. Here they are just saying insurance claim was accepted by the insurance company, right, against that damaged. So basically we will have the part of it will be goods, right? Then damage, which will be the loss, and insurance company's account, because this amount is receivable from them. It's not received yet. It is accepted by them, but it's not paid by them. So we will take that into consideration. So let's see how it should be written. Now, basically, you will have first part of this transaction that has happened is goods are lost by fire. So goods account, goods are lost. Second is, what is the loss that is happening? Loss by fire. So this will be another account, lost by fire. And third is insurance company account. Insurance company account, because this amount is receivable from them. Now goods account, goods are going out, so it is credited because it's lost. No? It's going out of the business. It's no longer in the business, so it's going out. So goods account is credited. Loss is, of course, loss, so it is debited. It's a nominal account. All accounts which are expense and losses are debit. Insurance company, has it given or has it received anything? The insurance company has admitted the claim, right? That means insurance company is the giver or the receiver in this case. In this case, insurance company is not the giver. They have to still give us. So insurance company in this case is just the one who has to make the payment to us. So they are debit for us because this amount is recoverable from them. It's like a short-term credit which the insurance company has taken to make us the payment. So insurance company account in this case has to be a debit. Now some may have a query that insurance company is the giver of this claim, then giver's account should be credit. Correct? Some may feel that way. But in this case, they are not yet given. Right? It's not yet given. So if they would have given the amount, there was no question of insurance company account only. So just like when we sell a product, how do we make the entry of sales? Just understand this. So you'll understand the insurance company account entry also. Entry of credit sales. Whenever you make credit sales, how do you write it? You say, suppose it is a credit sale to ABC Limited. So what do you write? You say ABC Limited debit to sales. This is how you would write it. In this case, it is basically ABC Company Limited is debited. Why? Because ABC Company has received the goods from us. So in this case, it is just like this insurance company has received the claim from us and they are still to make the payment. So that is the reason insurance company is the pay amount is receivable from the insurance company. Any receivable will be an asset for us and any asset will become a debit. Okay. So with due course, you'll understand this as we proceed ahead more in detail. You will understand this transaction more clearly. Right now, remember, this is a recoverable amount and insurance company has just admitted the claim and not paid us. So they are not the giver yet. They are in fact the receiver of that claim. So in this case, how do I journalize this entry? I will first write loss by fire, right? Account debit. Now, is the entire amount loss 10,000? Sorry, 10,000 was the amount of the lost goods, out of which 50% is recoverable. So only 5,000 is the actual loss, right? Actual loss is not the entire value. Actual loss is only half of the amount of 10,000, which will become 5,000. Then insurance company account. How much will insurance company pay us? Insurance company is not making the payment of 10,000. They're just going to pay us 5,000. This is the recoverable amount. So I write here 5,000 to goods account because the goods are going out of the business. Goods account. How much goods will be cleared up from the business? 10,000. This is lost, right? This is not going to be got back. What is going to be got back is basically this amount of 5,000 only. And the rest 5,000 we will have to show in a profit and loss account as a loss, correct? So being goods damaged by fire. So describe that transaction, goods damaged by fire. Insurance company admitted claim of 50%. Insurance company admitted 50% claim. Right? So this is how you can journalize the transaction. Second transaction is done. Now let's proceed to the third transaction that we have here. Third transaction says goods worth 10,000 were damaged by floods in the area and insurance company claim received was 70% of the value of damage. Now here there is a slight change. If you see insurance claim received, got it? So any time when it is said insurance claim has been received, that means it is not recoverable. Insurance company's name need not be written. What you need to write here will be the amount received in the form of cash or bank. Now, in this case, it is not stated whether insurance company has made the payment by cash or whether it is paid by bank. But in normal courses and in usual courses, no insurance company will make the payment in cash, right? So they will give a check to you or they will transfer the money to your account. So we will need to take into consideration this receipt which is happening. This will be via bank. Now let's see which accounts are involved in this case. Accounts involved will be, first of all, you will have the amount of goods. Right? What is damage? Goods. Correct? How were they damaged by floods? So loss by floods account or loss by flood account. And third one, do we write here insurance company? No, we will write here bank. Right? Bank account. We have amount which is actually got in the format of the bank, in the format of a check from the insurance company, because 70% of the amount was given by the insurance company. Where did we receive the amount? It was received in the bank. Goods account, loss by flood, and bank account. Now some people, just to give you another idea, what I can do is I'll just show you one more thing. How some people write this will be just to show you how I reached this final transaction up to goods lost by flood and bank. I will show you some other details. How normally it happens. Basically what has happened is goods have gone out of the business and there is loss which has happened. So loss by flood, I will write loss by flood account. Debit amount, how much I've lost is 3,000 because insurance company has admitted the claim. So I'll write here insurance company account, just like we wrote by fire in that case, 7,000, and to goods account, 10,000. Now, in this case, the end is not here. What has happened? This insurance company has made the payment to us. So we received the money in our bank account debit, 7,000, right? And to insurance company account, 7,000. So one side we are debiting this particular account and second side we are crediting this account. So this gets crossed, this gets zero. And so what remains is the entry that we will make. This is loss by flood, bank account and goods account. These three is what we have here. Got it? So this is how the transaction will be journalized because insurance company is no longer required. Now one is debit and one is credit. So this has automatically cancelled the effect, right? So what remains is 3,000, 10,000 and here this 7,000 of bank entry. So this I put it in the journal. I go to the journal and I write third one, loss by flood account, debit, 3,000 because 70% is admitted by insurance company and it has received. Bank is the receiver of the money, bank account debit, 7,000. And what is going out from the business? What is damaged and going out? It is goods. So to goods account, 10,000. Right? In brackets, we'll write being goods damaged by floods, insurance company paid claim of 70%. Insurance company paid claim of 70%. So this is how the transaction will be noted in the journal. So have you understood that we have debited the losses? Bank money has been received by the bank. Bank is the receiver and goods are going out from the business. So goods are credited. Next transaction, Madhukar defaulted in payment of 10,000 against the sales made to him. The amount is now unrecoverable from him. Now, such type of transactions, when I say it is connected with the sales transactions are generally, when we speak of the sales transactions are for debtors. So, sales on credit. When I say sales are made on credit, it relates to debtors. And when debtor defaults, due to whatever reason, it becomes bad debts. It's called as bad debts. And this bad debts is a loss, right? So here what we have, whenever I say that there is a sales transaction that has happened, sales transaction made to Madhukar and he defaulted. So automatically what should come to your mind is nothing but bad debts. So here I have two accounts. One is bad debts and whose account was now unrecoverable. It is Madhukar's account. So the second account will be Madhukar's account. Now what question may come to your mind is, why am I not writing sales account? Why am I not writing any other account? So to answer that, if you can see, basically whenever I make a sales transaction, let's say sales to Madhukar. If I write sales to Madhukar, it will be Madhukar account debit, right, to sales. This is how the transaction will be recorded. Sales to Madhukar will be recorded like this. Now, if I say cash is received from Madhukar, cash received from Madhukar, will you again write sales? No. Cash is received from Madhukar, meaning against this amount receivable, suppose this amount receivable was 1,000. I am going to receive the cash received from Madhukar, full value. Okay, full value. That means this 1000 was received. So what do I write for this transaction? I will write cash account debit. Cash is received to Madhukar's account. So against the sales made, I have already recorded the value of sales. So I don't have to record sales again when cash is received. When cash is received from Madhukar, I just have cash account and Madhukar's account. Similarly, if I say now instead of cash received, I replace this by bad debts, right? Madhukar defaulted in payment of amount of this. So what will I have? I will have these two accounts in the transaction, bad debts and Madhukar. There will be no sales. So hopefully that is clear now, that why I'm not recording sales transaction, or I'm not showing it as credit sales made to Madhukar, right? Because that's already recorded. Now, what has happened? Where is the problem happening? The problem is happening when Madhukar has defaulted in payments. So, bad debts and Madhukar account will be the two accounts. How much value he has defaulted? He has defaulted 10,000, and it is unrecoverable. It's very clearly given it's not recoverable from him, so it becomes bad debts. So, let's write the fourth transaction in the journal. In the journal, I will put this as fourth transaction, bad debts account. Now, I don't need to write bad debts loss account necessarily, because bad debts itself shows that it is a loss. So 10,000 and to Madhukar's account. Who gave us this loss? Madhukar gave us this loss. So Madhukar's account is credit. Debit is bad debts because it is a loss. Right? So hope this part of the transaction is clear, why we took bad debts and why we took Madhukar's account. Now let's write here the narration being Madhukar defaulted in payment amount not recoverable. Madhukar defaulted payment of credit sales and amount unrecoverable or amount not recoverable. Right? So this closes the transaction. Now let's proceed to the fifth transaction. What is the fifth transaction saying? The fifth transaction says Kavita became insolvent. This word insolvent, focus on this. Amount receivable from her was 10,000. Receivable, okay? This amount is recoverable from her, 10,000. Only 40 paise in a rupee was recoverable. So understand first of all what is the meaning of insolvent. Now you may have often seen that a bank has given a loan to someone. Maybe in your neighborhood, bank gives loan, right? And when the loan is to be recovered and the person does not make the payment, it has to be recovered, right? But if there is a default, what action does the bank take if the loan becomes a default? Then in this case, they either sell their asset, right, and recover the loan. Do you get it? So if the bank has given the loan against a car, let's say, and this loan is not recovered by them fully. So if there is a default, then they would sell the car, and then from the whatever value the car gets, they will recover the loan. Now suppose if I say that the bank gave a loan of 10,000. This was the loan amount. When they sold the car, this car gave them a value of only 9,000. So the car could not pay off the loan completely. So what happens in this case? 1,000 becomes a loss, right? The loan could not be recovered fully, so 1,000 becomes a loss. The same thing can happen in the case of credit sales. So imagine you sold on credit, goods sold on credit. Amount of 10,000. And person became insolvent. Insolvent means his assets are less than the liabilities. So like in this case, if I say, for example, the car was worth of 9,000 and the loan was worth 10,000. So what has happened here? Even if you sell off the whole of assets, you can recover only 9,000. Obviously, that 1,000 is a loss, right? So in case of insolvency, when a person becomes insolvent, it's basically that all his assets sold off cannot pay off the loans and liabilities that he has. So that is why it is a case of insolvency, bankruptcy, as we call it. So you may have heard of this term, at least sometimes you may have come across this term, bankruptcy and insolvency. So that is basically when a person's assets are insufficient to recover the liabilities. Now, what happens if the assets are sufficient only to a certain extent? If you see here, they said that only 40 paise in a rupee was recoverable. So for each rupee, what are they saying? For each rupee, how much is recoverable? 40 paise. So in the way, we can say 40% is recoverable. So of the entire value, only 40% is recoverable, rest is lost. So how would you write this particular transaction now? When you have to write this transaction, you will need to put it as, we have two to three things here. One you have is the amount of money that is recoverable. So what is recoverable? 4,000 in this case, because 40 paise in a rupee was recoverable. Out of this 10,000, you can recover 4,000. So cash account, one is cash account you will be receiving is 4,000. Second is Kavita, who is going to make the payment and who is going to create the loss is Kavita. Kavita had to pay how much? 10,000. So her account is zero now, zeroed down 10,000. And what about the rest 6,000? It is lost by insolvency. Right? Loss by insolvency is 6,000. So these are the different accounts that we have. Cash is a real account, Kavita is personal account, and loss is nominal account. So real account says debit what comes in, credit what goes out. Cash is coming in, so debit. Kavita is the giver, so credit. And loss is loss. Obviously, nominal account says losses are debit. So this is debit. So let's write in the journal now. Journalize this transaction. First, take all the debits. Cash account debit. 4,000, which is recovered. Loss by insolvency. This is also debit, 6,000. And 2, Kavita's account. This will be total amount of 10,000 as a credit. So being Kavita became insolvent and 40 paise in a rupee was recovered. Being Kavita became insolvent and 40 paise in a rupee was recovered. Right? So this is how you would put the transaction for insolvency. The last part that we are dealing with in the complex journal entries is connected to free samples. Now, you often find that there are many people who come door to door. These days, it's quite less, but still, yes, there are people who come door to door and give us free sample of products and say, okay, try this. And if you like, this is now available in the market. So what is a free sample given away for? It's not given for fun, right? It's given for some motive by the business. What is the motive? That your product should be known in the market. So it's like a marketing strategy. It's more like an advertisement, correct? So it could fall under the head of advertisement and marketing expenditures. So at the same time, the goods which have gone out of your business are no longer coming back. They are not a loss for the business. It can't be termed as loss because it is done with a specific motive in mind, keeping in mind that this amount is going towards an expenditure of advertisement, correct? So this is how you can say the free samples are recorded in your journal. it's given basically for what are the qualities of a free sample. It should be given for the purpose of business promotion. They are also given sometimes for testing of quality, like some vendor, some person who is going to buy from you in bulk says that, okay, first send me 10 samples of your product. If I like it, then I will buy, right? So that is again a free sample. Then this is basically, you have to record it as advertisement and sales promotion expenditure in the journal. Fine, got it? So we will take these examples now, how to journalize them, how to write them in the journal. Fine. Now coming to the examples of free samples. Free sample, they are saying here just two transactions are here, past journal entries for these transactions. What is happening? Goods distributed as free sample worth 1000. Goods distributed as free samples. When we say goods are distributed, two parts of the transaction will be, two parts of this transaction that we will have is goods. And second, why are we distributing these goods? It's distributed as free sample, meaning it will be advertisement and marketing. So I will just write advertisement account. So two accounts here are goods account and advertisement account. Goods account, goods are going out or coming in, it is going out. And advertisement is expenditure. So advertisement is debit. So I write here advertisement account debit to goods account 1000. Right? In brackets, you can write being goods distributed as free samples. Being goods distributed as free samples. Second transaction says goods given as free sample to Manohar. So whom are you given this particular free sample? You are giving it to Manohar. You are giving goods and you are paying for advertisement. Is any money recoverable from Manohar? No. So we don't need Manohar's account because we are not recovering anything from Manohar. It's just goods and again advertisement. So some people may get confused because the name here, there is some mention of a name. But even though the name is mentioned, it is not necessary to consider that name because it has no meaning. Unless and until there is something recoverable from him, we don't need to write his name, right? So goods are given, but they are not given for some recovery from Manohar, but it is just given for the purpose of advertisement. So it's just a closure of that transaction by taking again the same, that is goods and advertisement, nothing else. So we will write here advertisement account debit, amount is whatever the amount, nothing is given. So I just assume it is 1000 again here to goods account. Same we can write here. We don't need to consider Manohar. We can write it in the narration being free samples given to Manohar. So remember, whenever you are not going to recover anything from any person, that means if I say sales, that means there is a legal action to be taken that the person has to make you the payment. But if you are not going to get anything from that person, then there is no point in writing that person's name. Correct? So in this case, why are you making the, why are you taking out the goods is not for the purpose of recovery of money, but it is for the purpose of advertisement. That is the reason the name is not mentioned in the transaction. So don't get confused whenever a name is used in the transaction stating free samples. So if free samples are distributed, it is just two things. One is the free sample part and second part will be the advertisement and not the name of the person. So this is how you would journalize the transactions connected with free samples. So now whatever we have learned, these 5 points that we have learned under the complex journal entries, now we will use them and we will now proceed to illustrations, which will give us, you can say, a combined effect of all these uh, transactions that we have learned. So how to write a journal, where you will have some of these type of transactions in journalizing the writing of your journal. So let's proceed to illustrations. Now we are going to proceed with the questions for journal entries, that is these complex journal entries. Now we'll have illustration 1 here, and I'm going to solve it for you. You will have to pay attention to how I'm picking up the different accounts and applying the basic formulas. That means you could say basic rules of the personal, real and nominal accounts, and then I'm going to write the journal entry. So let's get started. If you see here, we have to record in the journal of Mr. Kirti. So I'm going to write in the book of journal, in the books of Mr. Kirti. Fine. Now, what is the date? The first date that we have on 2nd, right? On 2nd of what month? May 23. So I'm going to first put the month May 2023 and 2nd. Correct? Now, started business with cash, machinery, and loan is taken in cash again. Okay. So if you remember the compound journal entry that we did, we have the account of cash, we have the account of machinery, we have the loan account, and we have basically the capital account, right? Because it started business, so capital account. So what all will be debited and what all will be credited, we'll have to identify first before we put it in the journal. So if you see cash account, cash is brought in, so it will be debit. Then machinery will be debit. Business is started, capital account always will be credit. Loan taken also, basically from Madhukar, loan will also be credit. Okay. Let's put this transaction now. Business, cash is coming in, cash account. Cash account is debit. Now remember here, if you see here, now, if you see here, cash is not just this particular 1,50,000, but it is also this 60,000 here. So total amount that you're going to have in the business is 2,10,000 of cash, right? So I'm going to directly write here 2,10,000. Then comes what is brought in is machinery. So machinery account debit. Account is debit. Amount is machinery account is debit, amount is 2 lakh rupees. So I'm putting here 2 lakh rupees. Capital that the person is bringing in, that is basically Kirti's. So to Kirti's capital account, since the person's name is given, Kirti is the person starting the business. So Kirti's capital account. How much amount will we need to take into consideration? See, basically we have 2 lakhs of machinery and also cash of 1,50,000. So 3,50,000 is something which is brought in as capital. So I'm putting here 3,50,000. Now, does this end the journal entry? No. We also have taken some loan. So loan from Madhukar. So loan from Madhukar account, 60,000 is taken. Right. So if you see your 4,10,000, here also we will get 4,10,000. In this way, the journal that entry that you have passed is correct, being business started with cash, machinery, and loan. Machinery and loan. This is how I narrate this particular transaction. Close this particular transaction in the journal. Go ahead to the next transaction now. So if you see what the first transaction we have done is an example of compound journal entries. 2 debits, 2 credits. So it becomes a compound journal entry. Let's go to the next date. 3rd, deposited 1 lakh into bank. What will you deposit? You're going to deposit cash, and the second account that you have is bank. Bank is the receiver. So receiver's account is debit. Amount that we are depositing is 1 lakh. Correct? Debit amount 1 lakh. And what are you going to deposit? Basically cash. So to cash account 1 lakh. Being being amount deposited in bank. Yes, second entry is done. Let's proceed to the third one. Now, third journal entry says purchased goods of rupees 15,000 from Manohar and Company, and they gave us trade discount of 10%. Purchased goods worth 15,000 from Manohar and Company, and they gave us trade discount of 10%. Goods worth 15,000. Manohar and Company, second account. So goods, that is purchases, and Manohar and Company are the two parts. They gave us trade discount of 10%. So what is the trade discount that we have got here is 1500, correct? This is your trade discount, 10% of 15,000. So this I will subtract from 15,000, and then whatever remains, that is 13,500, will be my purchases from Manohar and Company. So directly I'm going to write 13,500. If you remember the trade discount and cash discount that we discussed, there will be no separate trade discount account. Directly I'm going to write purchases account debit after reducing the trade discount. So 13,500 to Manohar and Company. 13,500. Being goods purchased on credit at 10% trade discount. $13,500, right? So hope this is clear, because we have the trade discount, we have not shown it separately. Again, I'm repeating it. Now coming to the next part. Paid Manohar and Company for goods purchased on 4th and received cash discount of 5%. So we are having how much worth of goods? 13,500 worth of goods. Manohar and Company were supposed to pay, but we did not pay them the entire 13,500. We are paying them after a 5% cash discount. So what we need to do is we have to take into consideration 13,500, which is the purchases. From this, I'm going to subtract 5% of 13,500, right? So on 13,500, I will take 5% of cash discount, which is 675, and I will subtract 13,500. So I get 12,825. This is what I'm going to pay in cash. And discount, cash discount that will be there is 675. Hope this is clear. So 13,500, on that I'm getting a 5% cash discount received. So that comes to 675. This I subtract from 13,500 and make the remainder of payment, which is 12,825. So what are the three accounts involved? It's Manohar and Company. Manohar and Company's receiver. So on 5th, I'm going to write here Manohar and Company debit. Manohar and Company account debit 13,500, because I'm going to clear their account completely, but I'm not clearing it with cash. I'm clearing it with two things. Cash account, I'm making the payment how much? To cash account. What is the amount that I'm making the payment? So I'm making the So what is the amount that I'm paying in cash? I'm paying in cash 12,825. So I'm going to write here on credit side, cash is going out 12,825. And two, discount, what am I doing? Given or received? It is received. So that's the reason I am crediting this discount receipt, because it is acting like my income, 675, or being cash paid to Manohar and Company, and received 5% cash discount on the purchases that we made earlier. So we paid less, we received a benefit of 675. Fine. So hope this transaction is clear to you. Next, we proceed to 7th of the month of May. Goods damaged by fire, 1000. So what are the two accounts? If you remember the loss transactions that we learned today. So we have two things here, goods, and second is loss by fire. So loss by fire, we will debit because it is loss. Nominal account says debit all losses and credit all incomes and gains. So debit loss by fire. So 7th, loss by fire account, debit. Amount that is lost by fire is how much? 1000. So I write here 1000. What is lost in this process? Goods. So goods are going out. We treat them as goods gone out. Goods account 1000. And in brackets, I'm going to write here being goods lost by fire. Got it? So this is how the transaction will be closed. Goods lost by fire. Next transaction that we have is goods distributed as free samples. Now again we have goods and we have free samples, in the sense we have advertisement we are paying for, in the sense we are actually incurring an expense of advertisement worth 500. So advertisement being expense is debit. So I write on the 8th in the journal, I'm going to write on the 8th, advertisement account, debit 500, and 2, goods account, because goods are going out, we are distributing them as free samples, 500. So being goods distributed as free samples. Correct? So close this transaction. We've closed this transaction. Next transaction that we have is on 10th. Laptop is purchased for 50,000 and installation charges paid 3,000. All the payment is done by check. So one is we have bank account, and second account is laptop account. Installation charges, as we know, the cost concept of accounting says the asset when purchased till whatever till it is put to use, whatever payments are done will be added to the value of the asset and it will be recorded at the price which you paid. So laptop will be one account, and bank account, because you are making the payment by check. Check account will not be written. Again and again, I've been stating this in the videos. Many people would make a mistake of writing check account. Check is not any kind of account. It's an instrument. It is not any kind of personal, real or nominal account. So you have to take only two accounts. One is the laptop account and second account is the bank account. So on 10th, I'm going to write here laptop account, fixed asset laptop account, debit. Total amount I'm going to write 50,000 plus 3,000, 53,000. Laptop account debit 53,000 to bank account, because we are paying by check. Whenever check payment word is used, you have to write bank account, not check account. Being laptop purchased and paid for installation and paid 3,000 for installation. Rupees 3,000 for installation. Right? Hope this is clear to you. On 11th, goods purchased from Manu 10,000. Very simple entry. Purchases and Manu. Nothing is paid. No bank, no cash is mentioned. So Manu account and purchase account on 11th. Purchases account is debit. Goods are coming in. Amount 10,000. And Manu is the giver of the goods to Manu's account. 10,000. Fine. And in brackets, you will write being goods purchased from Manu. Correct? This transaction is over. Next transaction on 15th, return goods damaged of 500 to Manu. What goods are being returned? Purchased goods. So purchase return is happening, and whom we are returning to? Manu, 500 rupees worth. So 15th, we have purchase returns. Manu's account is debit with 500 and 2 purchase returns. 500 being goods returned to Manu. So that was your transaction on the 15th of the month. Next, we have the transaction on 18th. Sold goods rupees 15,000 worth and gave 10% cash discount to KK Limited. Now, will KK Limited be written anywhere? No. KK Limited account we don't need because we are talking about cash discount. So we have sales on one side, we have the cash discount given on the other side, and obviously since we have given cash discount, the third account that we have will be cash account. We are receiving the cash. So sales is happening, cash is being received, and on the other side we are also giving a 10% cash discount. So 18th I will write the transaction. 18th, I am receiving the cash account debit. How much cash I am receiving? 13,500 because I'm giving a 10% cash discount. 1,500 is the discount in this case. So discount given account is my expense. Discount given account debit because it is expense. 1,500. And to sales. How much sales is taking place total? Sales account that I have is 15,000. So here you can write in brackets being goods sold to KK at 10% cash discount. So I'm writing everything in the narration so that the person reading this transaction understands what exactly has happened. Fine. Next, now we have KK Limited returned goods of 100 rupees worth gross and paid back amount to them. So what is happening? KK Limited has returned the goods and this goods are 100 rupees worth gross. Gross means before discount. Now when we are having a sales return taking place, should we take this 100 rupees or should we take 90 rupees into consideration and reverse the cash discount? The answer is we have to take this 100 rupees but in divided format, 90 rupees, which will be in terms of the amount of cash to be paid, 10 rupees will be the discount reversed, and third entry will be for third account will be for sales return. Now, when we are having sales return, sales is credited, so sales return is debited. So 20th, I will write sales return account. Sales return account debit. Amount of sales return happening is 100. 2. This amount of cash was received here, 13,500, of which now we are returning back some cash. Cash account, how much are we returning back? 90 rupees worth of cash I am returning because they were defective. Then we also are reversing this discount given account. Right, now this discount given account here, we are reversing on the date of 20th, 10 rupees. Being goods returned by KK Limited and discount given reversed. Got it? So this is how we will complete this particular transaction, which was gross amount, which is returned, right? So sales return is taking place and we are reversing the discount account. Fine. So this completes our illustration 1. Now we will proceed to illustration 2. Before that, on your own, you can just take the total of both sides of the journal. I'm not doing it here, but you can just take the total and this total should match. If it matches, then we have done it correctly. Okay, it should match. Moving on to illustration 2 on complex journal entries. Let's see what the second illustration is speaking about. This is saying journalize the following transactions in the books of Mr. Kumar for the month of April 2023. So we are going to write in the books of Mr. Kumar. And what is the date that we are writing this journal for? Date is April 2023. And first transaction is happening on 2nd April. So I'm writing here 2nd. What is the transaction? Kumar commenced business with cash and furniture 30,000. So 3 accounts here are furniture, cash, and basically Mr. Kumar's capital account. So let's write this transaction. Cash is coming into the business. Cash account debit. Amount of cash is 80,000. Furniture account, furniture is also coming into the business. So furniture account debit. Amount is 30,000. And 2, Kumar's capital account. This is 1,10,000. Being business started with cash and furniture. Closing this first transaction, it's done. Next that we have is bank account opened by depositing cash 30,000. So cash is deposited naturally, and the second part of this transaction is bank. Basically, we have cash and bank are the 2 accounts. Let's write this transaction on 3rd. Bank account debit because bank is the receiver. Debit 30,000. We are depositing the cash in the bank. Second part is to cash account. Cash is going out from the business. Cash account credit 30,000. And narration you will write being amount deposited in bank. Right? Close this transaction. Next transaction that we are moving on to Next journal entry we are supposed to do is on 4th. Bought merchandise from Cuckoo and Company 5,000. They gave us 10% trade discount and 2% cash discount. Now here we have two parts. One is basically Cuckoo and Company is giving us the goods and they have offered the 10% trade discount. So how much is the actual value of the purchases that we are making from Cuckoo and Company? It is 5,000 less 10% of 5,000, which is 500. So purchases that we will be making will be equal to 5,000 minus 10% of 5,000, which is the discounted amount, which is 4,500, correct? So 4,500 is our base value of purchases from Cuckoo and Company. Now remember, Cuckoo and Company is the one which is getting money in the format of cash because they have given us cash discount. If the word cash discount is mentioned, by now we know that the amount is paid off, correct? So basically, how much is the cash discount now we need to calculate? On what value will we calculate? We will calculate on the value of 4,500. So 2% cash discount we will compute on 4,500, which comes to rupees 90. Right? So 90 rupees is the discount. Remainder amount, how much we pay in cash? How do we calculate how much we pay in cash? 4,500 minus the amount of 90 rupees, which is the discount amount. So 4,410, you're going to make the payment in cash, right? So again, I'm repeating, we have to first reduce the trade discount of 10% or that Cuckoo and Company has given us, right? So that comes to 4,500, which is the purchases amount. We don't need to write two transactions, first stating Cuckoo and Company and purchase and then again cash discount. No need. Purchases made are 4,500 and these are paid off. And when we are making the payment, we received a 2% cash discount. So if we say 2% cash discount, basically it should be 4,500 into 2%, which is 90 rupees of discount. And when this discount is subtracted from the amount of 4,500, we get 4,410, which is basically the amount to be paid to Cuckoo and Company. So let's write the transaction in the journal now. On 4th, what is happening? We are making purchases. 4th, purchases account, debit. Amount of purchases, directly we write the amount after trade discount 4,500. Next is we are paying in cash. So cash account, we are going to credit. How much amount are we making the payment? 4,410. 4,410. And remainder amount is discount received. So discount received account. Amount of 90 rupees is the discount received, right? We'll write in brackets being purchased goods from Cuckoo and Company. Merchandise means basically goods only. Purchased goods from Cuckoo and Company at what is the rate of trade discount? 10%. At 10% trade discount and 2% cash discount. So this is how we write the trade discount and cash discount combined journal entry. Fine. Now let's proceed next. We are taking the return goods to Cuckoo 1,000 gross. Okay. Cuckoo had given us goods at 10% trade discount. So basically Cuckoo and Company, we are returning goods of 1,000 gross. So purchase returns, when we write this transaction for purchase returns, remember that the amount will be after the trade discount. So trade discount was 10% given by Cuckoo and Company, if you remember in the previous part of this illustration, they are giving us 10% trade discount and 2% cash discount. So this we need to consider when we are returning goods. So 10% trade discount, first let us calculate. That comes to how much? 100 rupees. So 1000 minus 100, which means 900 is the amount of purchase returns. Fine. Now of this 900 also, we are not going to have the amount of 900 because 2% was cash discount. So when we return the goods, the 2% of cash discount also needs to be reversed. Correct. So on 900, we are going to compute 2%, which is 18 rupees. So cash discount to reverse will be 2% of 900 and this comes to 18 rupees. So cash received back, we are assuming that cash is received back from Cuckoo and Company, will be this amount of 900 minus 18 rupees, which comes to 882. So 900 minus 18 rupees, 882. This is how we can compute the goods return entry. So assumption here is that Cuckoo returned us the cash amount. So let's write the entry for purchase return. This is on 5th. We are returning the goods. Purchases were debit. So now debit transactions that we have here is cash discount reversal. Discount received, I am going to reverse. Discount received account. This is reversal. So I am writing the debit. Amount of reversal is 18 rupees. Amount of reversal is 18 rupees. Then we have the cash account because cash is received, na, back. 882 cash is received and 2 purchases returns account. This amount will be 900, being goods returned to Cuckoo and Company. $1,000 gross. Okay, I'm writing here. So you know that you're reversing the trade discount and the cash discount that they gave. Fine. So that ends the transaction. Next is on 6th. Now what is happening? On 6th, we are selling goods to Madhav of 6,000 rupees worth on credit. This is a very simple transaction, sales transaction on credit. So Madhav is on 7th, we have Madhav's account debit. Madhav is the receiver of the goods. Madhav's account debit to sales account. The amount that we have is 6,000, correct? So both sides, debit and credit, I'm going to write 6,000. And being goods sold on credit. Next transaction that we have is on 7th, Madhav became insolvent and on only 30 paise in a rupee could be recovered. Fine. So as we know, this is a transaction of loss, insolvency. Loss by insolvency is happening. So one we have is Madhav's account. Second we have is the loss by insolvency, or in terms we can say it is bad debts. So here we are having some bad debts. And finally, some amount is recovered. So recovery account will be the cash account. We'll receive some amount from Madhav. Now, basically two parts, cash is coming in and bad debts is a loss. So on, okay, this was on 6th. Fine. So on 7th, Madhav is giving us some money. So cash account debit. We will do the calculation in a minute. Then we have bad debts account because this is a loss. Bad debts account will be debit. and to Madhav. Who is giving us both these things? It is Madhav. So Madhav's account will be credit. Now understand this particular part. You are receiving 30 paise in a rupee. How much was receivable from him? Amount receivable from him was 6,000. So 6,000 into, you will get amount of 30 paise in a rupee. So 30% basically. So 1,800 is recovered. Rest of it, that is from 6,000, if you reduce this 1,800, you will get the amount which is non-recoverable or which is bad debts. And Madhav is giving us these two things. Loss also he is giving us and cash also he is giving us. So his account will be credit with 6,000. This closes Madhav's account. If you see Madhav account debit, Madhav account credit. So it becomes 0. Being Madhav became insolvent, and 30 paise in rupee could be recovered. Right? So this is on 7th what happened. Next is on 8th. Goods were damaged by fire, 500 rupees worth, and insurance company admitted a claim of 300. Fine. So goods account is one account, damage by fire is another account, and insurance company is giving us payable. So, or receivable from insurance company's account will be the third account. Goods are going out because they're damaged by fire. Loss by fire is a nominal account, loss is debited. Company has to make us a payment. It is the person who is still for us the receivable amount. So that account will be debit. So let's take on 8th the transaction. The transaction will be basically loss by fire. Fire only, no? Yes, loss by fire account. How much is lost completely? 200 rupees, right? Insurance company is going to pay us payable amount, receivable amount from insurance company is 300. And to whose account will it be? To goods account, because goods are lost, right? So goods account 500. Write the narration being loss by fire and insurance company admitted claim of 300. Fine. So this is how you will write the transaction for the loss. Loss by fire. Now next, 10th, what is happening? 10th, we have find that it is bought additional machinery of 10,000 and installation and testing charges were 300, both paid in cash. So we are buying machinery and we are paying some installation, which will also be included in the cost of machinery, and we are paying in cash. So machinery and cash are two accounts. So we will have on 10th, we have machinery account debit. Machinery account is debit. Amount will not be just 10,000, but it will be 10,300 because you are paying for installation and testing. To cash account, 10,300. Into brackets, write down being machinery purchased and installation paid. Machinery purchased and rupees 300 paid as installation. Installation as well as testing. Okay. This is the end of the transaction on 10th. Now next transaction is on 12th. 12th, what is happening? We are sending goods to Kamal and company as free samples were 200. Don't get confused with the wording of Kamal and company. We don't need this at all. What we need is goods and this part of free samples, meaning the advertisement amount, right? So two accounts here are advertisement account and goods account, and amount is 200. So let's write the transaction on 12th. Advertisement account, debit 200, and 2, what are you doing here? You're sending the goods as free samples. So goods account is going out. So 2 goods account 200. In brackets, you can write Kamal and company and all that, right? So being goods given as free samples to Kamal and company. Close this transaction. Next one we have on 18th, goods sold to Nita Enterprises 1000 and gave them 10% trade discount. So this is again a simple one. We have 1000 minus trade discount of 100. So we have 900 of sales, right? Goods sold. So sales is 900 because trade discount is not separately disclosed. So let's write the transaction on 18th. Nita and company account debit 900 rupees directly and to sales account 900. In brackets, we write being goods sold on credit. At 10% trade discount. Fine. Goods sold on credit at 10% trade discount. Fine. Now, what is happening next is Nita Enterprise. So, it's not Nita and Company, it's Nita Enterprises here. Instead of Nita and Company, it is Nita Enterprises. So, let me correct this. Okay. Now, next on 21st, Nita Enterprises returned goods of 100 gross. So 100 gross means 100 minus that 10% discount of 10 rupees, which means 90 rupees worth of goods were returned. So we are making the sales return entry and Nita Enterprises will be the other part. So 21st, I write sales return account debit. Amount is 90 to Nita Enterprises. Account 90 being goods returned. Being goods returned rupees 100 gross. Right? So this is the end of the transaction on 21st. Last transaction is related to cash embezzled by cashier worth 1000. So we have cash which is stolen by the cashier of 1000. So this is again a loss entry. The loss which we have to record is of 1000 and it is by embezzlement, or you could say by theft. So 30th we will record the transaction as loss by theft. Account debit 1000 and to cash, right? Cash is going out. What is lost is cash. So cash is going out 1000 being cash embezzled by cashier. Being cash embezzled by cashier, right? So close this transaction. So that ends our illustration 2. You can again same way take the total here of both sides of the journal entries and you'll see that both sides will be matched. So with this explanation and the two illustrations that we did at the end of this particular video, hopefully the process of solving the complex journal entries must be clear to you now. So you'll have to practice this a little because there could be some confusions and problems. So more you do practice on such kind of questions, you will gain more confidence. So basic concepts, I have explained everything in this video. Once you know the concept, you have the conceptual clarity, you should be able to do it. Now in the next part, after the complex journal entries, we'll be dealing with the subsidiary books, ledger, trial balance, and we'll proceed to the final accounts also ahead in the upcoming videos. So stay subscribed and watch the upcoming videos on this channel, Commerce GYAN. Thank you.